This just in, Vietnam's central bank has officially announced the setting of a new benchmark rate for the Vietnamese Dong at 5.30. The move, which comes amid a turbulent regional economic landscape and ongoing pressure from international trade partners, has sent ripples across Southeast Asian financial markets. The State Bank of Vietnam's decision to peg the dong at this specific level is raising questions among analysts and investors alike. Namely, is this rate truly locked in, or is it a temporary stabilization measure in response to external volatility? According to the central bank's recent policy briefing, the 5.30 dong rate is part of what officials are calling a controlled response to both domestic inflation concerns and external currency fluctuations, particularly the weakening of regional currencies against the US dollar. Over the past 2 months, the Vietnamese dong has seen incremental downward pressure, primarily driven by narrowing trade surpluses and a global rise in interest rates. Vietnam's economy, while robust in manufacturing and exports, has faced headwinds in recent quarters, especially due to lower global demand, a tightening U.S. monetary policy, and increased capital outflows from emerging markets. By fixing the dong at this 5.30 rate, the state bank is aiming to project stability and maintain investor confidence. However, the rate's precision and the communication surrounding it suggests that it may be more symbolic than structural. Experts are noting the careful language used in the official release, which avoided describing the rate as a long-term peg. Instead, officials emphasized it as a reference point for both interbank transactions and public sector accounting. This nuance has not gone unnoticed. Currency analysts from several international financial institutions are interpreting the move as a short-term intervention rather than a definitive monetary stance. They highlight that previous similar adjustments in the dong's exchange corridor have been reversed or rebalanced in a matter of weeks, particularly when external economic pressures ease or internal metrics shift. In this case, the question remains whether 5.30 is a response to immediate instability or whether the central bank is sending a more permanent signal to the market. In the hours following the announcement, Vietnamese bonds held relatively steady, while equities across the VN index saw a minor dip before rebounding slightly on late-day trades. Meanwhile, Forex markets showed signs of tightening, with commercial banks narrowing their dong dollar spread in anticipation of potential intervention. Notably, foreign direct investment data released just before the announcement indicated a slowdown in inflows compared to the previous quarter, sparking speculation that the 5.30 rate is aimed, at least in part, at making Vietnam more attractive to outside capital by ensuring predictability in currency value. Adding to the intrigue is the fact that this move comes at a time when other central banks in the region are favoring more flexible exchange rate policies. Thailand, Indonesia, and the Philippines have all allowed their currencies to fluctuate more freely in recent months, arguing that market-driven rates are better suited to absorb global economic shocks. Vietnam's apparent divergence from this approach may suggest a more defensive posture, one that prioritizes internal balance over external alignment. Still, Vietnam's economic fundamentals remain strong. With consistent growth in its tech manufacturing sector and a steady rise in domestic consumption, the country is well positioned to weather moderate currency shifts. However, any artificial fixing of the exchange rate carries inherent risks. If the dong comes under speculative attack or if trade imbalances widen further, the central bank could be forced to defend the 5.30 level by drawing on reserves or tightening liquidity, both of which could have unintended economic consequences. One major factor to watch is how Vietnam's trading partners react. The United States, in particular, has in the past scrutinized Vietnam's currency practices, even going so far as to label the country a currency manipulator under the previous administration. Although that designation was later withdrawn, the risk of reigniting such concerns remains. If Washington views this move as a de facto peg aimed at gaining trade advantage, it could complicate negotiations or even trigger retaliatory measures. Meanwhile, local businesses are adjusting to the new rate with cautious optimism. Exporters, especially in the textile and electronic sectors, may benefit from a more stable dong, which allows for better forecasting and contract pricing. On the other hand, importers could face tighter margins if the dollar continues to strengthen globally, increasing the cost of foreign goods and components. Small and medium-sized enterprises, which form the backbone of Vietnam's economy, are particularly vulnerable to shifts in exchange rate policy, and many are awaiting further guidance from the central bank. Adding to the complexity is the potential impact on Vietnam's real estate and construction sectors. A fixed exchange rate can influence the cost of imported materials and foreign-funded development projects. If the dong's value remains artificially high, developers could face rising input costs, while overseas investors may find their returns squeezed when converting profits back to their home currencies. Conversely, if the peg holds and inflation is contained, it could provide a foundation for renewed growth in a sector that has been showing signs of contraction since late last year. International observers are also closely monitoring the geopolitical backdrop. Vietnam's strategic position in the Asia-Pacific region makes its economic decisions particularly consequential, especially as global supply chains realign and countries seek alternatives to Chinese manufacturing. A stabilized dong could position Vietnam as a more reliable partner for multinational corporations looking to diversify production, but it could also limit the country's ability to respond dynamically to rapid changes in global demand. Monetary policy insiders suggest that the 5.30 rate could be revisited as early as the next quarter, depending on macroeconomic indicators such as inflation, export performance, and capital flows. In the meantime, the central bank is expected to increase its communication efforts, both domestically and internationally, to clarify its position and reduce market uncertainty. Any perceived lack of transparency could exacerbate volatility, particularly among foreign investors who require a clear understanding of policy trajectories. At this juncture, the question remains open. Is 5.30 truly locked in, or is it a placeholder, a psychological threshold meant to anchor expectations while leaving room for maneuver? The answer may lie in how the State Bank of Vietnam responds to the coming weeks of market feedback. If the currency holds and key indicators trend positively, policymakers may double down on the rate as a semi-permanent reference. If pressures mount, however, adjustments may follow, either subtly through intervention or more directly through rate modification. As of today, the international financial community is treating the 5.30 rate with measured caution. Bond yield curves, Forex contracts, and investment flows are all reacting in real time to the perceived durability of this decision. Should the state bank choose to reinforce the rate with policy support, including tighter capital controls or fiscal incentives, the market may begin to interpret it as more than just a guidepost. Until then, it remains a critical indicator, a signal, not a sentence, on where Vietnam sees itself in the evolving global financial order. We will continue monitoring the situation closely as further details emerge. The coming weeks will be pivotal in determining whether Vietnam's central bank has truly locked in the dong at 5.30, or whether the rate is merely the latest in a series of calibrated adjustments. In the fluid world of currency policy, even the most deliberate decisions are rarely final. Investors, policymakers, and citizens alike will be watching and waiting to see just how fixed the future really is.